Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Jim Oliver. He founded Create Tailwind in 1988, a financial firm that now focuses on infinite banking concept of being your own banker, a unique investment strategy that helps certain individuals minimize taxes and interest expenses. Jim himself has utilized the strategy to start and purchase over 30 companies himself. So thank you so much for coming on the show today, Jim.
Thank you, Charles. Thanks for having me. And I look forward to spending some time with the audience.
Yes. This is a topic that we don't talk about much. I think it's been years since we've had a professional on to talk about infinite banking and being your own banker. So before we get into everything encompassing that, can you give us a little background about yourself, both personally and professionally, prior to getting involved with alternative investments in infinite banking?
Yeah. So I grew up in Los Angeles. I grew up in the inner city of Los Angeles, and I was fascinated with people that lived in really nice neighborhoods and seemed to have endless amounts of money in my narrow point of view. And I thought they have a perfect life living in, say, Palos Verdes, for example, in Los Angeles. And I was living in Inglewood, and I thought, what do they know that the people that live here don't know? I thought they had to know about money. They had to know how money works. So I was always fascinated with that. So when I went to school, I studied business so that I could start learning about money. And then I got out of school. I went and got a position as a fee-based financial babysitter. A financial planner. And I thought, now I'm going to learn about money. I'm going to learn about how to invest money. But no, I was just a middleman. But I was a pretty good middleman. I had $700 million under management at one point in time. And I thought, you know what? This is pretty easy. I just got to take everybody to lunch, take them to play golf. This is my life. But then I got this report one day, Charles, and it said that our clients for this period of time got 9.38% on their money. And I thought, doesn't seem like I have money in that account. It doesn't seem like we got 9.38%. So I went and I looked at the net after taxes, fees, everything. And it was like, oh, wait a minute. That's like 4%. That doesn't make sense. Why are we telling everybody they're getting 9.38%? They're not really getting that. And so I started diving into how my clients made money. And I went, wait a minute. What I'm doing is not what they need to be doing. And it's not how they made their money. And so by chance, I ran into Nelson Nash, who was doing a 10-hour course on infinite banking, becoming your own banker. And I thought, become my own banker? That sounds kind of cool. I want to be my own banker. And I went to his course in Texas, and I was like, this guy's either brilliant or he's crazy. And I wasn't sure which one. And so he said, hey, I asked him a bunch of questions after the seminar. He was very gracious, and he just answered all my questions. He was in his late 70s at the time, and he had just spoken for like 6 hours straight. And he said, hey, I'm doing this again in 2 weeks. Come back. It'll make more sense the second time through. So I did. And about halfway through, I had this aha moment. Like, wait a minute. You finance every single thing that you buy. You either pay interest or you give up interest you could have earned somewhere else. And if I could eliminate that problem for people, i.e. they could become their own banker, what an impact that would have on their wealth. So maybe I should focus on that, not on what they're going to do with their money, where they're going to invest it. Whether it's in the stock market, real estate, hard money, lending. I've seen everything that you can imagine, right? I'll focus on controlling the money pool. And that's kind of how I got into infinite banking. And I kind of see it as a ledger, right? The money pool is on the left side of the ledger. And the assets, and I know that'll drive CPAs and accounting majors crazy, but the assets are on the right side of the ledger, right? And the reason I keep it like that is because I want you to think about this differently and backwards. But I'm just going to show you how to control the money. And then what you do with the money is that's up to you, what you know, or who you can partner with or whatever.
So can you give us like an overview of what infinite banking is? I think people have heard it a lot, and I think it's something that's marketed with many different names and kind of specialties depending on who they're trying to attract.
Yeah. So infinite banking, the way that most people explain infinite banking is during your lifetime, you're going to spend a lot of money on interest, financing cars and credit cards and other debt. Some people say mortgages, but I kind of would argue that too, just especially in the last few years where mortgage rates were. But if the average person pays 40% of their net income to interest, and we all know that the biggest reason for that is the mortgage, right? In the beginning, 85% or more goes towards interest. And so that's why, and it's volume of interest, not interest rate. So every dollar you earn, 40 cents goes to interest. Well, so these, people say you need to start financing your own cars and all this stuff. That's not really what we do, Charles, with infinite banking. That's kind of how it got its start. But what Nelson did is Nelson explained to me how he bought this airplane with some partners. Mm-hmm. And then when they weren't using it, they leased it out. And it was a cash flowing asset. And I said, oh, okay, that's infinite. That's what I got excited about with infinite banking is I can put money in this insurance contract, this very specially designed insurance contract. It's guaranteed to grow every single day. And I buy it from a mutual insurance company. So mutual insurance companies are owned by policyholders, right? Not shareholders. And insurance companies are required to distribute the profits to the owners, policyholders, in the form of a dividend. So, so what happens is you have this money sitting in this account. And because you have that money and because you're an owner, you have a contractual right to take an interest only loan at between 4 and 5%, even today, of the insurance company's money. Your money never leaves that account. It's in there guaranteed, growing, tax-free, guaranteed every single day. The insurance company has to give you their money. They collateralize your account so that's safe for them. They are going to charge you 4 or 5% and interest only, right? So now you take the insurance company's money, other people's money, you have use and control of that, and you go buy assets, or you go buy funds, or you go buy whatever is your specialty or who you've partnered with. And when those things earn money, you flow it back into the insurance contract and you rinse and repeat. So if it was real estate, I see this a lot with doctors. Doctors they don't have time for real estate. So they partner with somebody. They're a passive investor in a real estate fund or something mm-hmm. like that. And as money comes back in, they don't need it to buy their groceries. So they flow it back into another investment, another investment, another investment. They create what I call velocity of money, not like velocity in science, but velocity of money, moving your money faster and faster and faster. So when you do that, buy these cash flowing assets, have this money pool, after a while, your investments are paying your premiums. And after a while, you put $1 into the insurance contract and you have more than $1 to go put into these investments. Then you have other people's money, you have use and control, and you have leverage. Because if I can put in $1 and have $1.50 to go put into the investment, I win. So then I just do that over and over and over again. So the insurance contract is never about the investment or the rate of return on the insurance contract. It's about the rights as a policyholder or policy owner and the intrinsic value of the insurance contract. That's what it becomes about.
So when you're speaking to professionals and I imagine business owners, is this a strategy that is usually utilized by high income earners and entrepreneurs? I mean, who is your target audience for this type of product?
I believe everybody can do it at some level, right? And I've had people start with $20,000. I've had people start with millions of dollars because it is about banking. And so if you think about like how a bank works is you have a depositor, they go down and they deposit money in the bank. Then that bank lends the money to a borrower, right? And then the borrower pays interest and then the bank pays the depositor as little interest as possible. You do the same kind of thing, right? And so if you started with $20,000 and you wanted to finance a vacation or pay off a credit card or a student loan or something like that, you could do it. If you, in business, when you look at the business cycle, most businesses use a bank, right? And they use a bank because the money flowing in sometimes is seasonal, and the money flowing out tends to not be as seasonal, more level, and the money coming in is up and down. So they use a bank and a line of credit. This is like using your own bank and using it for equipment and vehicles, and it could be trucks, it could be anything else. And in Nelson Nash's book, who's kind of the godfather, this has always been around and wealthy people have always used this. Nelson really brought it down to the everyday person's level. And Nelson gives an example of somebody financing their landscaping trucks. And over their career, they end up with $2 million more by financing those trucks themselves than if they would have financed it through the finance company. So anybody can do it. The more money you have, the more benefit I think you get, and the more options you get. And if you're a business owner and you're borrowing money, then definitely you can benefit from it.
So what I've read before on this when doing my limited research was that there's usually some sort of set time period between the time I open an account to the time that I can borrow against it. Can you talk to more about how that works?
Yeah. So the companies there's a bunch of different mutual insurance companies out there. They're all investing in the same thing. They all have the same reinsurance treaties or similar treaties. And they're all working with the same numbers, right? The same mortality and everything else. So what we do is we look for companies that don't let you, quote, season the money, like for a year or whatever. We literally can get people loans a week, 2 weeks after they deposit money in the account. So, I don't want them to wait. Some companies require you to wait a year to take a loan. I don't want to do that. You want your money moving. Motion is the law of God. If air's got to flow in and out of our bodies, blood has to flow through our bodies, money's got to flow.
What are the costs usually associated with someone coming in to open one of these accounts and maintain it over several years? Yeah.
So, the costs are, it's an insurance contract. So when you have two different components, you have the whole life policy, and then you have this rider called the paid up additions rider. The paid up additions is dollar for dollar. It's always dollar for dollar. There's literally in the companies that we use, there's literally no fees in that, right? It's on the life insurance side. So let's say 60% was going into the PUA and 40% is going into the whole life policy. On that 40%, in the very beginning, you have setup costs and underwriting costs and commissions and all of that in that first year. So that's why Dave Ramsey and Susie Orman don't like whole life insurance, is because they look at that first year, you put in $1 and you have not much to use, right? In that first year. The second year, the companies we use, the second year, it's like 95% of what you put in. So if I put in $100,000, I have $95,000, and I only have a little bit of a cash drag of $5,000. The first year it might be I put in $100,000 and I have like 60 or 65. And there are people out there that advocate to add a term rider, reduce the base whole life policy down to 10 or 20%, and have more of that paid up additions, which is just dollar for dollar. But that's a better way to start first, but that's not the better way to finish first, because what happens is that whole life policy, once it kind of gets up and running, takes a couple of years. Every dollar you put in there, you have more than $1 to go use. Right? Now, if it's just sitting there, like certain companies want you to sit it there and park it there for 20, 30, 40 years, then you could say, I put in this amount of money. This is what it's worth. That's my rate of return. But if I'm taking it and using the insurance company's money, then it's whatever it's returning in there, which is, it's small. It's guaranteed. It's cash. It's what I'm doing with their money. That's where the return is. Like if I take $100,000 and I had 95 to use, and I give you the $95,000 and I say, Charles, go invest that money for me, and you get me 20%. Well, I don't care that the insurance contract got 3 or 3.6. I don't really care about that, right? I mean, 3 or 3.6, who cares? I got 20 on this side, or I got 12 on this side, or 10 or 8 or whatever it is. So then as that money comes back in and it's going and it's flowing, I have more and more and more an ever increasing money pool to go put money in the investment. But by year, like say year 10, okay, if I put in $1, I have $1.50 to go use. And that's if I did no infinite banking. I just have the insurance contract. Well, so if you wrote me a check for 100 grand and I turn around and wrote you one for 150, you'd be okay with that, right? And you're going to go invest it. By the way, if I made you that deal and that was the ratio, do you want that first check to be big, the one that you're going to write me? Do you want it to be big or small?
I want the one to write to you, small.
No, you want it to be big because I'm going to write you a bigger one, right? It's going to be 50% more. So you're going to be like, hey, Jim, could I write you a check for 10 million? And then you write me one back for 15.
Gotcha.
So the way to look at this loan too, Charles, is kind of like this, is if I would loan you today $100 million and your only obligation is 1 year from today, you got to pay me $5 million of interest. Would you take the loan?
Yes.
Absolutely, right? Okay, so like if you did that with me, I'm going to take your 100 million. I'm going to go borrow 400 million from the seller or the bank, and I'm going to buy a $500 million hundred Okay. And now when I do that kind of investing, I want to get 25% cash on cash. So your 100 million, I want to net after debt load, 25 million bucks. So I call you in a year and I say, Charles, I've got your check for $5 million of interest, right? And I'd like to drive over Alligator Alley and give you your check and take you to Prime Fish, okay? And you say, hey, I love that restaurant. So we go to dinner and I hand you your check and you say, Jim, do you want to pay any principal? And I say, nope, see you next year, right? That's the kind of loan that you're getting from the insurance contract. Your only obligation is to pay the interest at the end of the year. They don't ask you what you're doing with it. They can't say no. You don't have to even have a payment, anything else. You just pay the interest at the end of the year.
Interesting. Very good. Yeah. So what is the time frame from the time that I want to access funds to the time that I can withdraw it?
Couple of days. Yeah. I mean, some companies, when I say that we can get things rushed, some companies are up to 5 business days. It just depends on what time of the year. Is it around tax time? Because people use, their insurance contracts to pay taxes, things like that.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
And what happens when someone passes away depending if they have money that's out already and they have these 2 different contracts? I mean, how does that work with your heirs?
Yeah, it's great. No, it's a great question, Charles. Is what happens is if they pass away and let's say they had a $3 million death benefit and they had $1 million loan, right? So that loan is wiped out and their family would get $2 million tax-free.
Interesting. Okay. Wow. That's very powerful. It's interesting because I've never gotten involved with infinite banking, but with one of my brokerage accounts, I have it, and it's like you can pull money out, and it's literally like overnight. It's a similar like strategy, and obviously there is no life insurance portion with that, and obviously you're invested into depending on what you're investing into, that can be not guaranteed, right? So. There's different things for people that have different, risk tolerances for where they're putting their money to be able to access it at, lower than what most people are going to be able to access their funds at. But let's talk about that for a second. So you're saying that interest rates that you were throwing out like 4 or 5. And I mean, What is it like a typical interest rate now? And does it work with, is it like a sliding scale? The more I take out, it's just a little lower. How does that work?
Yeah, so there's two different types of loans and there's two insurance companies in the country that allow you to take either type of loan. There's one called direct recognition, and it's a fixed interest rate. So it's 4% fixed. But it reduces your dividend by 50 basis points. Okay. Or there's a non-direct recognition loan, which is variable. So right now, and it's only at 5.2%, and it doesn't affect your dividend. So depending on what the dividend is paying, what year you are in the insurance contract, all of those things go into factors are factored in to say, okay, if I take the direct recognition or the non-direct recognition, which one is better? And so you can take, that's the range right now on loans. And Nelson Nash, when he kind of discovered this for himself, it was in 1980, and he was paying 23% on $500,000. And he looked at his insurance contract, and he could take a loan for 8% at that time.
Wow.
And he was like, wait a minute. Why would I have these loans with the bank when I could have a loan to the insurance contract company for 8%? And he did it. And he took the loan, and it saved his real estate portfolio.
Wow. Yeah, that's crazy. That is a huge savings in interest there. So you're being around a lot of alternative investments. You were in the traditional realm, let's say, for many years, and now you're more of a, I would say, alternative investor. You work with a lot of alternative investors, because I imagine people that are taking money out of these accounts are not investing into stocks mainly. I imagine it's into businesses or whatever they want, but I imagine it's more alternative investments from the people I've spoken to that utilize this strategy. What are some common mistakes that maybe you've seen real estate investors make, or any type of investor make before, that maybe you've worked with that's worked with infinite banking?
Yeah, the mistake that I see sometimes is people they don't take loans. They just put the money in the insurance contract, and then they don't use it and go make those investments. So that's probably the most common thing that happens, right? But then if they do go make those loans, sometimes they don't know who to partner with. And so I've seen people make mistakes and partner with people they shouldn't have partnered with, right? Or I see people take it and borrow it out for something, and they don't pay themselves back, or they don't flow the money back in so they can use it over and over again, so they don't get that velocity of money, get that money moving, or they don't pay themselves a high enough interest. Those are probably the most common mistakes. And honestly, a lot of people make mistakes along the way, or, hey, I could have done that better, but that's kind of a learning curve, just like anything else. But in alternative investments, like you said, like real estate, well, right now, a lot of people are like, well, real estate isn't where to put, I don't want to buy real estate. Well, maybe I don't want to buy certain types of real estate. Maybe I don't want to finance multifamily, but, RV parks, there's, subject to, there's lots of things that you can be doing. But if you go back to the richest man in Babylon, one of the tenets is invest in what you know. So if I'm a dentist and I lease my operatories, I think that's what they're called, is my TV screen and the equipment and the chair. Normally they lease that for around 12% or so, maybe 15% now. And the volume of interest is much higher on that, because they're going to do 4 or 5 year lease. So they might be paying 25% of every dollar that they're paying goes to interest. Well, I'll finance those if I'm the dentist, and I'll finance my building, and I'll finance the, other things, a remodel, whatever it is, right? So there are things that you just naturally would use your own bank for.
Yeah, that's a great example. That's probably one of the most important investing strategies or thoughts, is just investing in what you understand. Because there's so many people that I've spoken to before that have lost money in investments, and when speaking to them, they don't understand it. You don't want to put anybody on the spot, right? But some people will say it, you know what I mean? But some people you just know they don't know what they're investing into. And that is a huge red flag. So for someone that sees your equipment every day, I love that. That's great because that's actually, that's a win-win for everybody.
Yeah.
So over 35 years in the personal financial space, how has your relationship towards money changed over those years?
Yeah, I used to, like I said, when I was poor and I didn't have money, I was obsessed with it. And what I realized is the more that I was obsessed with it, the less that it flowed to me, right? Now, when I focus on serving other people and helping other people, that's how I ended up with these businesses, because it would be, well, this person is having this problem or this problem. I've seen that before. It's like anything else. Once you've done it a few times, it's like, oh, you have a 112 problem. Yeah. There's only so many problems. This is yours, right? And so, I realized that if I just help people, it's kind of the old Zig Ziglar thing. If you help people, then you're going to get more than what you expect back. And all of a sudden, I just had money flowing to me. So my obsession with money became an obsession with freedom. And now I would tell you, money gives you choices. Choices give you freedom. And so what most people do, because they're exchanging time for money, they equate money to their lives, and that's how they measure their worth, right? We say your net worth is X, right? Well, once you have your net worth to a certain point, it's more like, what's your impact? What's your contribution? And the more that you focus on impact and contribution and serving, your net worth goes up and up and up, way more than if you focus on, hey, I got to go make some money.
Yeah. When I speak to people that are potentially new investors, and when you're really talking to them, if they're going to be active or passive, and it's really the freedom. It always comes. You can always boil it down to getting to the freedom. No one wants like a ton of money in their bank account. It's really, I want the freedom, and the autonomy to do what I want, what I want, all this kind of stuff. So it's very true. So one thing we didn't talk about, Jim, that I thought would be kind of best to leave in your court is that you have a new book. You sent me out a preview of it. A lot of interesting information in there. I read some of the chapters, some of the highlights, some of the chapters. So tell us about your book and tell us about everything that you've put in there.
Yeah. So here's a copy of the book. It's Make Bank Without the Bank. And the title, Charles, when we're, especially depends on where we're from. That's why I'm smiling, because, depending on where you're from, your slang for money could be a lot of different things. Right. And I think it's funny because depending on where you grew up, that's what you call it. And so we would always say, man, I'm going to make bank, and so then with infinite banking, it was like make bank without the bank. But it starts off and it tells kind of a story of my childhood being poor. And I worked in this casket factory, and 13 years old, I literally built the hardware for caskets. And there was a guy that owned it, Dwayne McIntyre. And I thought, man, he just walks around. He's not here that much. What's he doing? He's the owner. Shouldn't he be running this business? And, he had people running the business. I'm swinging a hammer all day long. And then one day I'm in Inglewood. I was like 13 that summer. And I'm walking down the street with a friend of mine. I look down and this guy's pulling weeds. And wait a minute, that's Dwayne McIntyre. Mr. McIntyre, what are you doing here? And he goes, oh, I own this house. So look, I'd love to tell you at 13 years old, this was like a light bulb going off for me, Charles, but it was like 20 years later. Okay. I went to public school. I'm not that bright. It was like, but 20 years later, it was like a light bulb went off. So in the book, I talk about everything I needed to know. I learned then, right? He owned businesses, real estate, and it wasn't in Palos Verdes where he lived. So in my book, I just tell the story about how I learned about money, and that basically I grew up with nothing. So if I can do it, you can do it. And I just kind of talk about a little bit in the first couple of chapters, my journey, and then I get into it. And the book's 98 pages. It's a quick read. I wanted it to be, I'm not trying to tell everybody everything about money. I'm just trying to give you some things to think about and some concepts to start your journey. And so that's really what the book is about. And There's an Audible version that we took away from David Goggins, where somebody else reads the chapter and then they interview me afterwards. And that was a lot of fun to put together.
Very cool. Very cool. Yeah, it's interesting when you're getting advice from older people when you're younger and you don't really know what to make of it. Not that you could have, you don't really have any experience in the world. And then you look back on it, you're like, oh yeah, that's person actually knew they're doing. This is exactly how it works. And that was really good advice. I just didn't know what to do with that at that time.
But thank goodness I got it, right? I mean, like sooner or later, it's like people say, I wish I would have known about infinite banking when I was in my 20s. Yeah, me too.
So how can our listeners learn more about you, get your book, and get in touch with you for your business?
Yeah, so go createtailwind.com is our website. You could email me, Jim Oliver, at createtailwind, all one word, .com. Or you can go to community.createtailwind.com or go on the Apple Store or Android Store and just search Create Tailwind, all one word. We have a community it's got free courses on there. You can learn everything that you would want to know about infinite banking. And one of the things that I'd like to do, Charles, is if anybody reaches out to me directly and they say they heard me on your show, I'd love to send you a copy I'll give you your choice, either my book or Nelson Nash's book on how to become your own banker.
Great. Well, thank you so much. And I bet some of our listeners will take you up on that. So thanks so much for coming on today, Jim, and letting us know about infinite banking, and looking forward to connecting with you here in the near future.
Thank you, Charles. Thanks for having me. And thank you, audience.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.